Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
Hey, Value Builder community. Today I have Fred Hubler, who has built wealth management empire with focusing on what wealthy, ultra-wealthy millionaires and even billionaires actually do with their money. Fred is the founder and CEO of Creative Capital Wealth Management Group, serving, like I mentioned, millionaires, billionaires, NFL players, and high net worth entrepreneurs across half of the country. He's one of 270 financial advisors registered with NFL Players Association and Forbes contributor, and he's going to be dropping knowledge bombs. And already in our 5 minutes preview call, I learned a lot. So what sets Fred apart is his focus on alternative investment strategies that go way beyond the traditional stocks and bonds. Fred, you've built a serious value by helping wealthy get even wealthier through the strategies that most people never heard about it. So how did you discover alternative investments were real secrets, and many of them in real estate, to building wealth right now you teach other people? What was that journey?
Absolutely. Well, thank you for having me, and it's awesome to be here. I grew up in Delaware County, Pennsylvania. I still say water. I do not come from money, and nobody worked harder than my parents. They never made it out of middle of the middle class. We had everything, but we didn't have everything everyone else had. We just had enough. We went to Disney once, 19 times. So we weren't poor. And again, there's a lot of people with wealth, but I grew up feeling like the rich got richer because they knew things that I didn't know and my parents didn't know. And 22 years in the business, not only can I guarantee you that is true, it is a government program called accreditation. So accreditation is the framework where the government says these investments are legitimate and they're registered, blah, 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 but no one can see it unless they're accredited. Mm-hmm. So as much as I do like working with the people that have Wikipedia pages, my real heart is helping people that look like my mom and dad, regular folk that just got to be accredited or just barely accredited. I don't work well with trust fund babies. If they didn't make the money, then they don't really honor it and they don't know what it takes to make money. And I think you and your listeners do. So my drive was I went to college, I got an MBA, I had my little briefcase. I actually still have my briefcase from back in the day. And I was climbing up the ladder to be an executive. And I decided after I did Y2K for a big company, I didn't get the promotion. I didn't get the raise. I'm like, well, what do I like to do? And I was doing my friends' taxes and building an E-Trade account for them while they were changing the oil in my car. So I was always into dollar signs. And if you ask me, there's a picture in my office of me with a little tiny toy briefcase. And if you asked me what I wanted to be to grow up, my answer was a millionaire. I had no idea what I was talking about. Like I didn't know. And like the adults were like, well, how are you going to do that? I'm like, I don't know. I'm just going to be a millionaire. Like so that was the beginning. I'm wired a little different. I started in investments at a brokerage firm that's probably in everyone's town, probably multiple offices. And my first day was 9/11. So my timing is horrible or great if you think about it. And I lasted 2 years because that was a traditional brokerage. Want to buy a bond, want to buy a stock, Merck's the stock of the day. And I felt disingenuous because if you bought the stock, I made a commission. If it went down and you sold it, I made a commission. Whether you made money or not was not part of the deal. And so after 2 years, like, I can do this better. My first office was the same zip code as Vanguard. Never going to be bigger, never going to be cheaper. And I'm a hardworking, lazy MBA. Like, I don't want to reinvent the wheel. And it's easier now with ChatGPT and all the AI. But if you look for and search for how wealthy, big pockets of wealth are managed, Harvard and Yale Foundation always comes out as a poster child. About 80% saw of their money of the foundations and most endowments are not in the stock market. The stock market's gambling. The value, like the thesis for the stock market is buy, hold, and hope. There's a bigger idiot that pays more for Tesla than what you just paid for. Like, that's not investing, that's hoping. And hope's not a strategy. So when I realized that the big money has 80% of the money not in the market, and there's really not that many tickers. We are told that the market is this gigantic ocean. It's 4 inches deep. There's maybe 1,200 tickers that everyone invests in. And there's maybe 5,400 tickers in total. Okay. But there's only one Facebook, one Exxon, one Tesla, one IBM. Like, there's not that many out there. Yeah. So I focused doing alternative investments 22 years ago. It was crickets. I was in left field. Now it's a $9 trillion business. And I never left being in the left field, but now the audience, me, and now I'm head of the pack, and I'm looking around saying, why are you looking at me?
So does that mean alternative investment as the asset class grew so much, or you just discovered it was always there, just wasn't invisible?
It was never this big.
Okay.
The people that have a lot of money, like the institutions, they were playing with each other's money. Like Harvard and Yale go to BlackRock or go to Cantor, Fitzgerald, like whoever the big players are, they're at this table and the money just keeps moving around. I'm going to reallocate to you. And so back in the day, they didn't really need retail money. And if you're a regular, and accreditation, just so people understand, it's $1 million in net worth, not counting your house. It's not everybody, but it's a lot of people. Or you can satisfy it by income. If you're single, 190,000 a year, and if you're married, 300,000 a year. Either of those, yeah, and most of your listeners or some of your listeners are. So when you're
correct,
when you have that kind of accreditation, you can see a whole different menu of the product suite. But now you have a problem of you don't know what's out there because it can't be advertised, and you don't know who offers them because they're kind of cliquey. Like I don't need any more. I'm here doing this for the friend that referred us to it. I'm happy if I don't get a client. I'm not doing this for a client. I have nothing to sell. So, I'm not out there doing, trying to raise the capital. So at the end of the day, when you're looking at alternative investments for your listeners, a lot of the holding is real estate based. And like that, what I'd love to share with your listeners are the things that are out there that can help them be more like the bigger bucks of money. So one of the things that's out there, and this is a give to your listeners, it's a website. It's I helped build it.
Appreciate that.
It's the initials DST. So DST, and I'll tell you what that stands for, -exchange.com. I will never, ever invest in anything that's not a .com. I think the .nets look like generic websites. I'm sorry. I'm old school. I will pay extra for a .com because that's just where that's legitimate to me. That's how old I am. So
one more time, DST hyphen.
Yeah. DST exchange with hyphen and .com. It's a free calculator. You don't have to log in. I don't care if you sit there, but it justifies the math behind whether you sell a property and pay taxes or whether you 1031 into another property. And obviously that's almost always the right answer. But the reason I'm sharing it with your listeners is the concept of a DST is a 19-year-old strategy that no one ever hears about, and it's starting to get some legs, and I'm helping with that.
Let's
I
uncover
wrote an article in Forbes that kind of got some good traction. If you and I were 15 people were invested in an investment together, we all had to agree. And that's really the world, the TIC world, the tenant in common world. We all have to agree. You can't have more than 36 people. And it was cumbersome because there's always, my family can't agree on what to have for Thanksgiving dessert. So the fact that investors that don't know each other are going to agree on movement. So about 19 years ago, a company went to the IRS and said, hey, can we put property in a Delaware Statutory Trust, which is what DST stands for, and then let investors who come in be proportionally owning the underlying property? Well, the reason it's a benefit to some of your listeners, and I know this for a fact because there's people that have called me and said, thank you. A realtor said thank you and had a real estate investor say thank you for the same thing. They had a property they wanted. The person was interested in selling. But when you sell a property you've owned for a while, you have capital gains. And unless that person who has the property has another home that they've already, they want a 1031 into
1031?
That 1031 is almost Latin for my headache exchanged for your headache. At least the property you currently own, you know what the warts are, in the CapEx. If you have to go scramble to buy another property just so you don't pay taxes when you sell your property, that becomes cumbersome.
Exactly. That's always catharsis experience.
Yeah. And the 1031, the math has to be identical or it blows up. So the fact that I want to buy your property and you magically happen to have another property you want to buy and it's all the same numbers, I got a bridge in Brooklyn that'll sell you if you believe that's going to work, because that's just not how it happens.
Plus, additionally, always against the wall, the clock is ticking.
Yeah, and then you end up buying something you didn't want to buy because you did want to sell because you want, So a DST is institutional. The ones we do are FINRA and SEC regulated, so they're not. I don't make them. You'll see names attached to them like Cantor Fitzgerald or Inland, CB Rich. There's a lot of names out there that you already know before you even knew me or you. That's what they're doing. They're buying a $300 million property. They put it in a DST. Maybe they'll put 50% leverage. So it's 150 of equity. Vanguard just made 150 million of equity. Why I told you that story. It's a different scale. But for your listeners, they either can offer this calculator to say, if I buy it, here's the numbers. And by the way, you don't have to have another headache. You can, and the website's built for this. It'll match you to a DST advisor like me. You might even get me. So, you don't get matched to it. But what it does it makes the transition smooth. Okay, I'll buy it from you, but before I buy it from you, I'm going to go see what DSTs I can get. But when you go into a DST, it's 100% passive and it's 100% real estate. So you get new depreciation, so it's not a REIT, it's not a partnership, it's not a mutual fund. Like it is, you will own 0.00025 of the Amazon distribution center or the multifamily. You get to pick. So it's everything. A DST typically is everything from student housing all the way to senior living, except for nothing with the word strip in it. No strip clubs, no strip malls or strip centers. Although strip clubs probably cash flow well, they're not institutions, and I'm not putting
so retail center could be the strip center, which is retail center. Can it be?
It can be, but nobody wants them because they're the things they're knocking down to put the So right now, what we're seeing from where's the assets going? New purchases of multifamily is there's some meat on the bones because the person that bought it at the interest rates that they bought it at. Now that their loans are coming due at higher interest rates, they were planning on refining out, not refining at a higher number. So there's some desperate sellers, which just means we're getting good prices. Storage is still hot. Industrial still hot relative to other stuff. Obviously, commercial, the only commercial we've ever done is essential retail. So think of the places that didn't close during COVID. There's DSTs that are playing in that world. So grocery stores, blood dialysis centers, tractor supply places, like those places were open even during COVID because we needed to do it. Even Hobby Lobby, as an example.
Yep.
They were open during COVID because people were like, I have nothing to do. I'm going to make an Afghan now. Like, I'm just going to start yarning. You playing with yarn. I guess yarning isn't a word.
Yeah, I have an analogy on this. It's probably like neighborhood center with a grocery store that was still actually active and more busy in COVID than
and the grocery stores, they need to update. They need to put the self-checkout center. So there's a lot of opportunities with your listeners, either to use the DST to dangle in front of the potential seller and say, hey, I'd like to buy your property. You probably don't want to pay taxes or deal with the 1031. Go to this website, play with the numbers. Because when your listeners tell the sellers to go use that website, they're going to see how much capital gain they would owe if they didn't do a DST. And they're probably not, most people aren't ever shown what a DST is because it's kind of clicky. And all DSTs have a very short shelf life. If we had one that's in our town, it was an $80 million multifamily and had 50% leverage, and every DST has different leverage. And as you know, with the 1031, if we get the request from someone say, I'd like to know the DST, we need to know, well, what's the debt of the property you're selling? Because I have to make sure you're going into a DST that has the same debt or higher. So you don't have to pay any boot. And there's some DSTs that are 80% leverage. Like we would mix it and make it work. Long story short, and again, this is for your seller, for your listeners to kind of entice the seller to sell so they can do their job. Once you have settlement, it's normal. You have a QI. That's not us. You have a third party QI. It's a real 1031. But once it settles, your paycheck starts the very next month. Every DST is already built, tenanted, and cash flowing before they're ever put into a product that people like me can show.
And this is mandated through some SEC federal regulation, or is that you talking about your pool of DSTs?
No, it is the law.
Okay.
There can't be, so every DST is fixed debt. If there's any debt, some are debt free, which is nice. But if you have debt on the property you're selling, you can't put it all into that DST or else you're going to owe the taxes. So we pick and choose. There's a lot, and there's some value add DSTs. So one of the ones I'm personally in, and this is closed. That's the neat thing with DSTs, is the good ones don't last long because that $80 million property I talked to you with that was in our local town had a 50% leverage. Again, $40 million of equity. Vanguard just made that, why I told you that sentence. It is not the same numbers. So it maybe was open for 3 weeks. So prior to that, you need to make sure you can get into the DST before you sell your property. And that's really our job, is make sure you got the equity. Because what the liability and the risk is, you see a DST you sell your property, by the time you settle, that DST is closed. Now what are you going to do? So it is not an easy job for us, but it's our job that we pick. And the best part for us is the sponsor, the people that make the DSTs, they pay us, not the investor. So if someone puts $100,000 or $1 million, and just because you're accredited doesn't mean you have to deal with $1 million investments. You got to be accredited, but you can do a $250,000 DST. Like you don't have to put $1 million into it, but your statement will show the $250,000. How we get paid, and we typically get paid a placement fee around 5% of the equity upfront by the sponsor, so by the person who built it, because they don't want to deal with the investor. They don't want to answer the questions. And if you're Cantor Fitzgerald or if you're Inland, your job is real estate, not answering the questions. And so they offset that to my firm. And anyone that's like our firm, we get paid once, but we get paid by the sponsor, which is nice because we're like, how'd you get paid? I'm like, I got paid the equity by, the bigger company, and they're still a client of ours. So it's not a transaction that we leave because they live. And this is another downside of a DST. And you can tell I'm a horrible salesperson because I'm leading with all the bad news because I think people deserve to know it. The biggest shock to people if they are not ready for it is my job is to make sure, think of a DST as a plane. I got to make sure it's going where you want to go for vacation. Are we going to Jamaica? Are we going to Mexico, Europe? Because once you're on the plane, you're not getting off for 5 to 8 years. Most DSTs are illiquid. And if you die on the plane, they're still not landing the plane. So if you die with a DST, your family still doesn't get any money until the plane lands in 5 to 8 years. The sponsor determines when to land. So when what we'll call the good old days, 5-6 years ago, real estate, there were DSTs that would double your money in 3 years. Well, those days are gone. That's never going to happen again. And that was just a function of interest rates and everything got frothy. And there was people there that thought they were smart. They were just in a good place. The wind was just blowing hard and they thought their sailboat was great. No, it's just the wind was blowing really hard. So there's a 5 to 8 year lockup, but when the plane comes in for a landing and you're going to get notice, hey, in 60 days, we're selling this property to BlackRock or to an insurance company. These are always institutional properties. I think the smallest DST we've ever seen was $15 million. Most of them are hundreds of millions of dollars. Like Amazon, you see those Amazon distribution centers on the turnpike and you're driving for miles and the building is still there. Amazon doesn't own that. They build it for themselves and they do a sale lease buyback. Usually they're owned by investors, and a lot of our DSTs, that's what they are. So you have a 20-year lease with Amazon, but you're only stuck for 5 to 8 years. So when the plane comes in for a landing, every investor gets 3 choices. Walk away and take your money. If you do that,
you take your money. So are they getting taxed?
Oh,
from the previous company
everything
capital gains that they converted?
Yeah. So the plane lands. If you leave the airport, all the taxes you deferred are going to be right there. You owe all of them. Not a recommendation to take door number 1, but I can't say there's 3 doors and not tell you all 3 doors. So door number 1, no one ever does, but you can. And sometimes people do it if they put cash in a DST. And this is for people, and again, for us, it's our doctors. Clients that, people that make $900,000 a year, they got the money, they don't have any time, and they don't have any bandwidth to be a landlord. Like some of my doctor clients are smart where they are, and they are, almost non-functional in other aspects of their life, which is great. Again, they're really, really smart people. And sometimes the smart people do really stupid things. But I want them to have real estate. They want to have real estate. Investors can put cash in a DST. So not do the 1031. And the reason you would do that is you don't have time to run the property, but you still want to own property. Or let's say you have 50 grand. What kind of property are you going to buy with 50 grand? It ain't going to be as stable as an Amazon distribution center 100%. Or an $80 million multifamily. So you can put 50 grand into an $800 million deal and you get your, 0.000000 of that thing. So there's 3 options when you land in the airport. Walk away and pay taxes. No one does that. Go on to another plane. So you can 1031. So let's say you put $250,000 in a DST and it's worth $500,000 down the road. Now you can roll that into another DST. Interestingly, shoot.
Now, question. So let's say when you roll, is there a time clock like on 1031? How much time do you have to roll from one DST to another one?
It's the same rules. It's instead of property to property, you're just doing package of a DST. So when you come in for a landing, you got 45 days to find something to roll into. Most of the time, we, just like you do, we don't want the long layovers. You're at the airport, you got the money. Let's just get on to the, let's go to
Next
your
one.
connection. So for our clients, we always have, here's the next ones that are available. Which one do you like? You already own an apartment, so let's do storage. You don't have any senior living, and it makes sense. And, and each of them are individual properties at a location with an address. So it's not like it's a black box. So if you keep swapping until you drop, and I'll use me because I just met you, but I'll use me and my wife. Let's say we put money into DST, which we had. And other than the properties where I live and work, and I have one more rental, I've gotten rid of all of my regular real estate and moved it all into DSTs. I'm making the same amount of money and I have none of the headaches. And so that was for me, because I'm busy, that was my answer. But if you keep swapping till you drop, at some point, let's say I have $1 million in DSTs and down the road, me and my wife both die. And it's worth $10 million. My kids get a data desk step up. So now they can leave the airport if they want to, because their taxes are not going to be nowhere near what mom and dad's tax. Yeah. So one is leave the airport and pay taxes. 2 is keep rolling. But 3, which is important for your listeners, instead of going into another commercial jet at the airport, you get off the airplane that the DST airplane, and you fly private. You can 1031 out of a DST back into a property you own directly, as long as you don't change the ownership.
At different bases.
Yep, at a different basis. So let's say that one of the DSTs come due, and at the same time, my wife sees an Airbnb she wants to buy. I can 1031 out of the DST once it lands and go buy the Airbnb, because it has to be an investment property. They have to solve. But so it doesn't tie people up. And interesting, when 2020 happened, obviously historical, we didn't know what was going on. We had a lot of guys saying, listen, I got money in this real estate that I already own. I don't know which way it's going. I don't know if things are going to get better or worse. And I want to be in safer real estate, not just have one tenant in one townhouse be what's paying the bill. So he sold his real estate, probably 14, 15 million bucks. And we put him into, I think, 7 different DSTs. And now he's making more money passively. And he's kind of itching now to get back in. So when his DSTs are coming in for land, he's already, he's asking me and I'm reaching out to the sponsors, when do you think you're going to sell? So we're giving him some guide path. He probably has a year, maybe a year and a half before the first of the DSTs come full cycle, because there's already interest in the properties. All the DSTs want to do when they own it, they have to grow revenue, because that's the real thing that makes the value worth more in the future. Interest rates definitely help. But if you're cash flowing much higher 5 years from now because you added the pickleball to the mobile home park, because a lot of our DSTs are some of them are mobile home parks. You're adding pickleball, or you're buying a property at the DST level. The DST sponsor is buying a property that's family owned. So they haven't, if your grandmom lives there, they haven't raised her rent in 20 years. Well, they probably should, and they haven't added any CapEx because they're using it to feed their family. The minute a family-owned mobile home gets into one of these DSTs, it does become corporate and it becomes better. They put money into it. They add more lights. They add more pads. So there's a DST I'm in that's closed. And the first year, it's making a whopping 4%, which is nothing. You're making better than that in money market anywhere probably. But the project, the actual mobile home community, is generating about 6%. And that difference, that it's not paying me or any of the investors, that 2% difference is going back into the property. And that's what they're using to pay for the pickleball. That's what they're using to add other mobile home pads. So I know when they sell that, when that plane lands in the future, it's a bigger plane. It's a different plane, because we took a haircut in income and added value. So there's DSTs that kind of scratch any itch someone has. And it's not the only thing I wanted to share with your with your listener, guys and girls, listeners, but it is something that calculator is free. You don't have to log in. That can help your listeners justify to the seller, hey, if you do a 1031, buy it from me, here's all the taxes you're going to save. And if you don't have another property, click on this, go get a free consultation with whoever you get matched up to and see if a DST makes sense. Because not everyone offers them. We're blessed. Yeah. I've been in the alt space for 20 plus years. So I will get calls from sponsors saying, hey, this thing's 60 million bucks. Before we give it to everyone else in the world, how much do you want? And I'll look at my clients. Also, look what our runway is, what clients are in a 1030, which ones are in that 45-minute. And if we need it, we take it. If we don't, we don't. So
awesome.
That was a long answer to a short question, but hopefully your listeners got a lot out of it.
Great. I'm learning so much, and you're explaining very, very thoroughly. I've heard about DST, but I never dove in. So based on right now, you just told me, it has a flavor of 1031 and reverse read. I want to ask you a question I really understand how DST works for the seller who is a tail end of his maybe investment career. And of course, it doesn't want to value add and he's just looking for very stable asset and defer his taxes or her taxes. Now, when I'm coming from operator's perspective, right? Let's say, and it's almost like a reverse read. Let's say if I have a properties or pool of properties, a portfolio, and I have a seller who wants to sell his properties, can I structure DST within my portfolio so we can get DST shares in those properties, and I took over his and do value add or whatnot. So another question is do I have to be a BlackRock to create a DST? Because we're thinking about the reverse REIT at some point.
Right.
Or is that really reachable for operators like my audience or us? Now, typical deal sizes, $3 to $10 million. There's maybe few of them above 10 and 15 and pushing 20, but not too many. So the question is, do you have to be a BlackRock to go DST route to offer this to your sellers?
Yes. So the short answer is yes. I have sponsors who are clients of mine, friends of mine. I love them. They're doing warehouse. They're doing mobile home, whatever they're doing. They're like, hey, so I've given them the DST documents. Like, here's what it says. The issue with the DST versus a TIC is simple. So in your case, I would see if there's a lawyer that can help you with a TIC just for that transaction. It's much simpler. The problem with the DST is it's built for massive scale. It's expensive if you're not going to have that scale. Number two, if any of the document is defective, everyone in that DST has a defective exchange, and you're going to owe the tax. You're going to be sued for the taxes they didn't think they needed to pay because they thought you were a regular DST. So the liability, the juice isn't worth the squeeze, Saul. Because you could, most people don't understand. It's 19 years old, but it's still like, I never heard of that. We have clients, $40 million portfolios of real estate, like ballers with a capital B. They'd know what a DST was. And I'm like, oh my God, I bought all this property myself if I knew I could get better property other places. Now there's fees, but the fees are typically not worth the client's time. Like we had one guy, the guy with 14 million, it was 1,400 doors. So some were duplexes, some was apartments, some were single. Well, the tenants of a, 14 million on 1,400 doors, that's not a lot per door. So it wasn't like a marquee portfolio. And I asked him, like, why are you selling this? Your life's work. He's like, I have 1,400 failure points. I couldn't find a management company that was worth their weight in gold. So I had to buy and start my own management company. So now I have two companies. He's like, I just like to use a hammer and fix up houses. Like he's blue, like he's just blue collared, like a regular guy. And he's the one that now saying, hey, I want to get back and start, fixing things. And I think what's really happening between, I don't know if you're married, so, but I think between the scene, I think he's done his wife's honeydew list. And now she's probably, he's probably getting on her nerves. So she's like, will you go out there and buy some property and get out of my hair? So we're working with him to when they come down. So I would, in your case or in that situation, I don't even look at the DST. It's just not the right fit. It's overly complicated, overly expensive for a one-off or a smaller deal. I would do a TIC because that's more flexible and has a lot less, more people know how to use that on the lawyer side and the people that you can, and I did, again, I gave it to one of the sponsors and he's like, I went to a lawyer. He's like, I couldn't even afford their consultation to tell me what I would need to do. Like, it's just so much beyond where we are, but that's where you need to be. If you're doing an $800 million DST every 3 months, you're splitting, the company that's putting that out there, they have billions and billions under real estate and it's a different scale.
Now, do you mind unpacking TIC a little bit, for someone also who is not so familiar, with this structure or this concept?
Excuse me. A TIC is a tenant in common, and it's the old way they did it before the DSTs were used. And it typically has caps of 36 investors, and they have to have that unanimous. Sorry, let me get a drink. That unanimous voting. Which, if it's just you and maybe two other partners, you're going to figure it out. If it's you and 300, investors, you're not making a decision. No one's making a decision. We're going to sell, and that's really the issue. It's like, hey, we want to sell this. We just got a really good offer. And you always have that one guy, and I don't know the male version of Karen. I think it's Kevin or Keith. We always have that one person saying, nope, not going to sell. I'm like, and triple our money, not going to do it. And so the TIC is good in smaller deals where you know everybody.
Mm-hmm.
And so, and you can Google tenant in common. I did write an article. So one of the other gives to your listeners, it's free to them.
Mm-hmm.
I'm a paid contributor to Forbes. So if you go to Forbes.com and put in my last name, Hubler, Hubler, you'll get all my articles. They're free to read. I think get 5 a week or 5 a month. I did one on DSTs and kind of like explained it in a different way. I know I talk fast. So if your listeners play this back at half speed, I'm a normal speed talker,
Mm-hmm.
but you get I'm authentic. You get I'm consistently.
You're dropping so much knowledge. I really appreciate that.
Right, you get to listen to it. You get replay. All your replays will go up like, I don't know what Fred just said. I got to hit rewind. So if you go to Forbes.com, because the other issue that we all have when you say alternative investments, it's like kind of me saying, Saul, picture the color blue. I don't know what shade blue you have. Now, if you ask me, it's going to be this color like teal because for some reason, I like that color. The word alternative is just like the color blue. You don't know what I mean when I say alternative. So every one of my articles at Forbes are only about alternative. Mm-hmm. Most of it real estate. I can talk about there's aggregation strategies in real estate. There's some neat, now that the big better bill, whatever that's called, there's some accelerated depreciation plays in real estate. And one thing that's neat in real estate that is a benefit, and it's interesting, is just if you're building a project, the IRS allows you to take your current value of that project. So let's say I give you $100,000 to go build, a duplex, and in 3 months you staked it out, but it's not built yet. Mm-hmm. Well, technically, you can tell me, Fred, your $100,000, if you had to get out right now, is worth 30 or 40 or 50,000. Like, it's not worth what I put into it because you didn't build it yet. So most people, that's not a benefit of an investment that you put 100,000 in and on paper it's worth 50. But it is if you're trying to get money out of your IRA into your Roth and you don't want to pay the full taxes. So one of the alternative investments that plays in real estate is a development. It's not a DST. It's a development real estate where you buy it in the IRA at the 100,000. It's a project. So then they have the ability and they're allowed to write the current value of that project is 50%. Now it's only worth 50,000. Your statement stays 100,000. You don't have to worry about giving your wife a heart attack. Hey, we just Fred lost half our money. Here we ready to go. No, it's built for this. So the statement value doesn't change, but the custodial value gets revalued down to 50. That's what we move into the Roth. And then eventually it goes back up and keeps on going. And once it's in a Roth, as you guys know, you never get taxed again. You never have to take it out. You can take it out whenever you take it out tax-free, and it grows tax-free. So for a lot of clients, we're playing real estate much in different levels and at different ways, depending on where they are. But that's the neat idea for, and I think the other thing I'd want to give your listeners, there's an investment out there, and it's an institutional investment. It's an aggregation play. So they put, and let's say that strip mall that no one wants, and it's yours, and you want to sell it. This company puts that under option, and then they do the hand-to-hand comment with the borough to get an approved, townhouse community. And this company knows that the Lennars and the Toll Brothers, like, they work with them and say, hey, where do you want to put a community? So what they do is they already know that there's someone that wants to be where your strip mall is. They option your strip mall, so don't buy it yet because they don't need it yet. So there's a fund out there that they do this about 30 different times. And so the reason I'm telling your listeners is they could do the same game. They can say, okay, can I get a builder and find out where they want to build? Because the builders don't want to do the hand-to-hand combat with the borough and, the sets and all that stuff. And there's work there, but there's a lot of money there because in one example, it was a $3 million strip mall that was dormant, maybe had a dry cleaner, but it was not marquee. They optioned it for 4. They said, we'll give you 4. The guy's like, sure. And you had like a 3-year option. And if it didn't work out, I think we were gone. The fund was down $100,000 or something. Mm-hmm. But, you just want to get out of the strip mall. Meanwhile, they knew that a developer wanted to go in that area and they knew what they wanted to develop. So they developed. And so when the dust settles, they actually it was like a $30 million deal. And I paid $5 million. Well, now we just made we just made a ton of money. We didn't have to buy your property, and we don't have to even be the builder. So that's where there's fun stuff, because the building, there's a lot of money in building, and there's a lot of headaches in building, and there's a lot of gray hairs in building. And so I would love to come back on your show because I just, kind of nipped, that's the top of the iceberg. But I think the articles on Forbes are free, and they'll learn about it, a lot about it. The DST calculator is free. They'll learn about that. I think both of those are tools. And that's really what I want to share with your team because, like I said, I'm happy. The more people have money, the happier everything is around them.
Yeah, that was really informative, man. And definitely, if we can, I would like to do another show. Probably gonna take just one specific topic, because you're just definitely a wealth of knowledge and you educated
Awesome.
me
I appreciate
so much
you
about
having me.
DST, and I'm pretty sure other folks got enlightened. Thank you for the website and then the Forbes articles. I'll go read it. I'm pretty sure many of my listeners go read it. So I would like to leave this episode with a question. If our listeners can take away one thing about building value from this conversation today, and we went to quite a few directions, what do you want that to be?
I think they should look and see if what they're doing, whatever it is working because they're lucky or working because they figured something out. And some people get blinded, including me, thinking you're smart when you're just not lucky, but you're in the right place at the right time. And the problem with being that is the times change. And then you find out, oh, I wasn't lucky. Just everyone was buying, storage was hot for 3 years. And I just happened to think I was a storage genius. And so you got to do that yourself because no one's going to do it for you. And then if you are lucky, reality will level set and you'll realize I wasn't lucky. And so that's my concern because there's a lot of unknown. I mean, tariffs and interest rates, all that stuff. It's all headwinds we all have, but we all have successes. So I would say, look at your successes. Okay, can I do that again in a different environment? That means you figured out something. If they're like, no, I can only do it when there's interest rates going down, I can refi and people have extra money because of COVID. Like there's a lot of things that aren't going to happen again. Exactly. And if you made money then, great. But if you can't make money without those things, then you got to figure out a different way to make money because that's not coming back. The free money that was coming out there, low interest rates, might get lower hopefully in September, but it won't be the free money that we had for as long as we had it. So
yeah, lately I have a
saying, defensive play.
Lately, have a saying is that if your strategy is that Disneyland time is going to come, it's not a strategy.
Right. Hope is not a strategy. Good luck is. I mean, it works. I'm glad you made money, but you got to. So it's more not where you should go. It's more about self-reflection and making sure that you actually did figure something out. And I figured out that if I make enough millionaires money, I'll be a millionaire myself. That was my, I cracked that egg and I'm like, how do I do that? Like, wait, there's all these investments. They don't know they need access. Why don't I get all the license and the access and the agreements of sale and understand it and expertise? And that's all I do. So I listen to myself sometimes. No one else does. Awesome. My kids don't, but I listen to myself.
Thank you very much, Fred. It's so amazing having you.
Love to come back and talk football next time.
Yeah, and for sure, I would love to do it again. And yeah, it was a great education. I'm pretty sure many of us will appreciate that for the future. And I'm looking to do another one.
Thank you.
Thank you.
You've been listening to the Value Builder Podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.